Chris Harvey, welcome back.
Thank you.
Head of Equity Strategy, of course. What do we make of what's happened in megacap lately and what's happened elsewhere lately?
Well, if you have momentum, it's great. If you don't have momentum, not so good. So everyone talks about the megacaps, and all you have to do is buy into the megacaps. But if you look at the megacaps that are in the momentum ETF and the ones that aren't, significant difference in year-to-date performance. Apple, Tesla not in there, Berkshire, and the rest, and they're having negative returns this year, and the rest are up about 25, anywhere between 25 and 29% on average. Big difference. So everyone, it's not just a large cap issue, it's a momentum issue, and it's right across the board. It also goes down to small cap. If you look at the return to the Russell 2000, Russell 2000 growth, S&P 400 growth, the big driver, super micro. Super micro accounts for almost 100% of the year-to-date return.
The stock only moves 50% every day, one way or the other.
That's it. That's not bad.
I mean, are you positive on the market? One thing that's interesting to me, and it hasn't happened to everybody,
right?
But this market has turned bears into bulls,
right?
Yourself included,
right?
And are you feeling now, even though we've come a long way since the October, November beginning low, that we still have a lot of room to go because of the Fed ultimately cutting rates? What would you say? So
the answer is I don't know, right? The answer is what you want to do is you want to be able to participate. You want your portfolio to be able to participate, but you want something in there, a hedge, because you can make a case that this market will blow up. Right? You can also
can you make a credible case that it will? And if so, what's that built on?
When I say blow up, it means both ways, right? You can make a case that the Fed's going to start cutting rates, M&A is going to take another step higher, that the macro is good enough, and that this is a momentum market. And in a momentum market, I haven't seen this kind of market since the late 90s. And you do not apply. We don't talk about the market so much. We talk about positioning, sectors, and stocks, because that's what happens. The disparity between the winners and the losers is phenomenal, right? And so you could have a situation where the winners just keep running, similar to the late 90s. But what's the difference between the late 90s and today? The fundamentals and the valuation are so much better than they were back then. And now what do you have is if the Fed starts cutting rates, if the GOP takes over the Senate, which means that regulation will change, you're going to have a really big boom in M&A activity, which means you're possibly going to have more speculation. On the reverse side, if I'm looking at the Fed, I'm saying to myself, Fed expectations are probably, or Fed's guidance and some of the Fed numbers are too conservative, right? They're saying that they're saying that GDP is going to be 1.5%. I highly doubt that we're going to have a 1.5% GDP environment. I think it's somewhere between 2.5. If that's true, 3 cuts, highly unlikely, and maybe no cuts this year. And that's a very different environment.
I'd say it's a bit of a stretch to think that we're not going to get any cuts this year.
But you can.
I mean, the chair himself.
It is a stretch.
Would probably think that's an outlier view because they know they need to cut, and Steve Leisman very well articulated all of the reasons why.
But it's within the realm of possibilities, right? We think they're going to.
It's a possibility. I mean, it's in the realm of possibility that we get hit by a bus when we walk out of here. But is that a high probability? We're going to look both ways before we cross the street.
I hope not. No, but if you look at what's on the ground, right, this is not the kind of environment that you typically cut rates in, right? S&P is in a bull market. Credit spreads less than 100 basis points. Economy better than expected. Unemployment less than 4%. You don't cut in that kind of environment.
Well, you do if you raised by 500 basis points in the span of 16 months.
Yeah, but what's breaking at this point in time?
You want to wait until there's a credit issue and then they're reactive?
Well, that should be showing up in credit spreads, but it's not, right?
Yes. So of course it's not now.
So we can wait a little bit. But you asked me, can we go up? Can we go down? I can make a plausible case. You can go both ways, right? It's more likely the upside. There's more pressure to the upside. But there's going to be risk at some point in this market, and that risk will probably be related to Fed and Fed expectations.
Well, I mean, of course, there's risk every day. There's one risk over both of our shoulders. It's trading right behind us, New York Community Bank.
Yeah.
Right? So you see how these issues come front and center. The belief, though, do you think this is idiosyncratic? You feel like there's anything worth keeping your eye on? Much to do about nothing big?
What has caught our eye, a couple of things. Rates over the last 2 weeks have come down on a 10-year about 20 basis points. More of a risk-on situation with bonds. Is that related to New York Community Bank? Maybe. What also concerns us is, hey, we go back to some of the biggest momentum markets in 98, 99 into long-term capital, which was an idiosyncratic issue. You had the S&P down 10%, you had small caps down 20%. So in a momentum market, you can get some pretty big moves, right? And they can be related to idiosyncratic issues or exogenous events.